Good evening, everyone. Welcome to Office Adda 24/7. My name is Niharika Valia Patnagar, and I'm with you with the area of ABFM. Am I audible as well as visible clearly? Please confirm. Good evening, everyone. Audible to you? Audible to you? Okay. Today I'm going to talk about our topic related to the area of ABFM, and I'm thinking to start with Module B since that is what I've heard from many of you that Module A has been covered in multiple areas. So I'm starting with the area of Module B instead of Module A there. So then, first of all, we'll start from Module A, then we'll proceed towards the other modules. Okay? So let's proceed further and let's look out for the particular topic. Good evening, everyone. Okay. Uh, Here comes the first question. The first question is actually a numerical question to look forward to. It talks about operating leverage. Okay, leverage is basically given in module B there. That is the second chapter in terms of your the module B. It says that the company sells 1000 units of product X at rupees 50, having a variable cost of rupees 30 per unit and the fixed cost of rupees 15,000. You have to calculate the degree of operating leverage. Good evening, everyone. Okay, getting the answer there. Sir, according to you, it's D. Okay, let's discuss this area. It is country divided by EBIT. The formula for degree of operating leverage is your contribution divided by EBIT. How do we calculate this part, everyone? First of all, you will have to calculate the contribution. It is 1000 is basically the number of units from 50 units of the variable cost. Okay. This is the total cost out of which technically 20 is basically your area of contribution, right? So if 20,000 is your contribution, 20 rupees per unit multiplied by 1000 units, this gives us our contribution. But from the contribution area you will also have to deduct the area of the fixed cost, which gives you earning before interest and tax. So in this case it's going to be 5000 divided by 20,000 divided by 5000, giving us an answer of 4 times there. Then everyone, so before we move forward, please share this session with as many people as possible, right? So that is what we look forward to. And plus, in case just a moment there. So if you're looking forward towards the more details, I'm going to provide more and more questions to you as well. Just a moment there. Okay. Apologies for the trouble, everyone. Am I audible clearly as well as visible right now? Okay. We were done with this particular question. This is the answer for this particular question, everyone. Good evening. Audio now? Audio available now? Okay. Here comes the next question, everyone. Second question is from the area of derivatives. Achha, derivatives is what exactly, everyone? Derivatives can be stated as something that is an underlying asset, the value of which will vary because of the fact that we are having uh, a particular, okay, derivative can be specified as a particular security with transaction in which we are doing it that has an underlying asset. The value of those assets change while we do not even possess the asset. We are just talking about the increase or decrease in price, and that is how we calculate that area. Okay? So this is related to the particular area of interest derivatives. Which of the following statements regarding the interest derivatives are correct? Interest rate derivatives are hedges used by institutional investors such as banks to combat the changes in market interest rate. Number two, the financial instrument that is based on the underlying assets whose value is affected in terms of interest rate derivatives. So in this case, what is correct? Very good, Debashi sir. The correct answer is actually C, as you could see there. It is both of these, 1 and 2 are correct. When we talk about interest rate derivatives, now people do not want to go through the fluctuations of interest rate. So what they do is they create a risk-based thing. They mitigate their risk by creating a counterparty transaction. That is what we call in terms of hedges. And the financial instrument based on underlying financial security. The point is, derivatives is never about one particular security there. The price of the security changes. Particular security is affected by a specific asset whose price goes up and down, and that affects our derivative directly. Okay? That is C, both 1 and 2. Acha, here comes a specific question on degree of financial leverage, everyone. So try this question as well, everyone. There would be a few numerical, for few theory questions. So this one's basically related to the area of degree of financial leverage. The formula for this is basically EPS, change in EPS upon change in EBIT. I got a particular doubt about this area, that ma'am, how do we find out where use change or where we have to use the normal case? See, the point is, when you are given two specific years scenarios or two specific years, then always follow the change in EPS upon this formula for change in EPS upon change in EBIT. Otherwise you will have to go for the normal one. In this case, they have given this portion that you have to find the change there. C, B, everybody else? Go ahead and answer, everyone, and if you like this session, please go ahead and share it among your peers. Go ahead and share it, everyone. And don't forget to like it. If you find this class useful, then kindly go ahead and share it among your peers. Okay. Now moving on to this area, we have to find the change in EPS upon change in EBIT. What I can see is I have to find the EBIT first. EBIT was 1 lakh and 1 lakh 50, everyone. Solving it for you properly there. Look at the question there. We had change in EPS and change in EBIT. EBIT change is basically what? 50,000 increase is there divided by original. Okay? This is the amount how to. The formula is basically the change divided by your previous scenario or previous year divided by your change in EBIT divided by previous scenario and previous year. Now this is what in terms of EBIT I am getting the point there. EBIT is 50,000 divided by 1 lakh, okay, into 100. So this comes out to be 50%. So I know that in terms of EBIT, 50% on the denominator side. In terms of EPS, it is going to be 6.5 minus 4 divided by 4, right? It is going to be 2.5 divided by 4, right? It's going to be 2.5 divided by 4 there. It comes out to be 62.5, everyone. So in this case, it's going to be 62.5 divided by 50%. It comes out to be A, B, C. Okay, getting different answers there. What is the correct answer, everyone? Divided 62.5 divided by 50. Please, when you are going through these questions with me now, do not hesitate. Keep your notebook and a pen with you and do these questions with me. Because now the problem that people face is they just become somewhat overconfident. Ki, "Oi, baat nahi, ho jayega." It can be done without any problem. But the fact is, when you are doing these questions on your own, that is where you get the clarity. If I am sitting here, that doesn't mean I do not try these questions. To be very honest, we always look forward to the solving of a particular question. Ki, how did we find out this question? So it's way better you actually go ahead and calculate it. It is 62.5 divided by 50%, right? Comes out to be 1.25, everyone. Correct answer is 1.25. The correct answer is 1.25. How do we find the change in EPS, everyone? How do we find this EPS? That is the new EPS, current minus previous year divided by previous year. This is for EPS. The same thing goes for current minus previous year divided by previous year in terms of EBIT for both, and then you multiply it by 100. Done, everyone? Then here comes the next question. This is related to the financial leverage again. You have to calculate the financial leverage. In this case, the problem is, this is again in terms of leverage, but the problem is there are no two different scenarios given, everyone. This is where this question would be a little different. Okay? After this, I think I can give you a little breather. Most of the questions after this would be a little theory part as well. We started with the practical portion there. And if you're scared of the practical part, just try these questions with me. That will be really helpful in your examination further. Okay, now when we talk about this question, it would be in terms of degree of financial leverage. What is the formula? The formula here would be EBIT upon EBT. It is EBIT divided by EBT. Earning before interest and tax, and divided by earning before tax. How do we solve this question, everyone? Quickly, go ahead and answer, everyone. Or shall I solve it with you? Nilavati ma'am? Vinita ma'am? Everyone else? You want me to try this question with you, or you would like to give me the solution first? Go ahead and answer, everyone. Okay. Now, let's look forward to this question as well. Let's find out the EBIT upon EBT. For this, first of all, I will have to find my EBIT. The total cost is of 24 lakh. Sure, sir. Then go ahead and try it. I'll just write the basics here. Sales is of rupees 24 lakhs. Okay. From this 24 lakh, you have to remove the variable cost, which is of 12 lakh. It is 50% of it. What is left, everyone? The remaining part is 12 lakh rupees. Na? Then from this 12 lakh, remove the fixed cost. Fixed cost is of 10 lakh rupees. What are we left with, everyone? We are just left with 2 lakh rupees. This is your contribution, and this is your EB, earning before interest and tax. Now they want earning before tax as well. In this case, it has borrowed 10 lakh rupees at the rate of 10% per annum. Now the point is, from this EBIT, you remove the I, you will get the EBT. So what would be the answer in this case? To be 2 lakh rupees minus your interest. Interest is of 1 from 10 lakh ka 10%. It would be 10% of 10 lakh rupees. Now it is 1 lakh rupees, so that means we are what? Lakh rupees. So it's gonna be 2 lakh divided by 1 lakh. So the answer would be what? Correct, Sridhar sir. Very good. The correct answer is 2 times, everyone. With these kind of questions, okay. I hope the question is visible now in a better way. Don't feel hesitated when we are dealing with these questions. I will go a little slower while doing the numerical part so that you can actually try that question. Believe when you are trying the questions na paper में होगा कि नहीं होगा, I don't know whether I'll be able to do it in the examination. That self doubt goes out because you are doing those questions. Then everyone, Anita ma'am, very good, getting the answers there. Please share the session, everyone. Then everyone, chaliye. Then let's move on with the next question. And this is a solution, everyone. Anybody who hasn't solved this question with me, then what you here as well. The entire question is solved for you. One of the basic ways to learn this part, if you helpful in module B, but also in module C as well. The formula is you take your sales, you remove the variable cost out of it. What you get is contribution. Once you get the contribution, then you remove the cost. You first remove variable, then you remove the fixed. This will give you the earning before interest and tax. Then you remove your interest, it will give you earning before tax, and then you remove the tax, that will give you earnings after tax. Though in your questions, most of the questions you do not reach up to the level of earnings after tax, but rest everything is definitely there. Right? Okay. Now shall we move on, everyone? If anybody is noting it down, then you can definitely go ahead with it. Now, here comes the next question, everyone. This is CAPM model. Acha, before we move forward, what is the CAPM model? Can you give me the definition of CAPM there? What is the full form of CAPM? What is the full form of CAPM, everyone? CAPM is Capital Asset Pricing Model. It is Capital Asset Pricing Model. They can definitely come up with a specific question from CAPM model as well. Now let's talk about what is a CAPM model as well. Acha, everyone, I'll be trying to cover at least not a specific question that we are dealing, but also a related part of it, that every question you get more and more, because the point is I don't want to stick you up only to the area that everything is going to be as per this question only. Sir, अब clear आ रही है? Everybody else, was there any voice issue? Okay. Now we were talking about the CAPM model ना. CAPM model का formula क्या होता है? उसका the formula is basically risk-free rate of return. Whatever the return that we are getting, we'll find it out. Plus we have beta. Then find a risk of the market, return from the market. That is, this is the entire formula. The formula says number one, risk-free rate of return. If I do not want to take any risk, I am too scared to take a risk. So that is where we take the risk-free rate of return. Thank you. Then beta is the multiplier, everyone. You've seen there are certain people called gossip mongers. You tell them this much and they will make in the market and would spread up the news. है ना? So in this case, what will happen is can be stated as something that is the multiplier. It can be in the positive side, on the negative side. Multiplier is beta. And then this part is called the risk premium. Why? In this area, you will take out if the market rate of return is given and the risk free rate of return is given. So that means the portion that is between them, This part is called the risk free. This is called the risk premium. That means, first of all, I'll take risk free rate of return. Risk I'm ready to take up. That is called risk premium there. Okay? So in this case, what is the risk-free rate in the CAPM model? The rate of return of security with high risk, the expected rate of return with no inherent risk, the rate of return of security with low risk, or expected rate of return with high risk. See, as I told you, this RF is called the risk-free rate of return, right? If they say it's a risk-free rate of return, so in this case, the one which is having no inherent risks. The plus point of CAPM model is that you choose what kind of risk premium you are ready to take up. Okay? So that's the formula, everyone. Okay. Now, in this case, the correct answer is B. Getting very surprised in terms of the answer. I would love to see that point that where everybody is answering because. Acha. Ma'am, audio is clearly, am I clearly audible right now? Because in my area, I cannot see there's any problem there. Sure. Just a, here comes the next question, everyone. Okay. Leelavati ma'am, I don't think there's any problem. Here it is coming clearly. I don't know what's the issue there. Just a moment. I think I'll have a word with the tech team. Go ahead and answer this question, everyone. Okay, the question says that a warrant is relatively dash option to buy dash at a predetermined excise price over a specified period of time. Just a second, please. Okay, everyone. Had a word with the tech team in case they can look out for this. They will check this out. Okay. As per the book, it's D. Yeah, this is a question from the book itself. Sir, I was having a word with the tech team there. I hope now I'm audible. Shidhar sir, sorted? Okay, then I'll keep a check on that, sir. Chaliye, in this case, a warrant is relatively a dash option. Is it a long term option or a short term option? See, the point is in this area, Sirisha ma'am, I think you are looking forward towards the correct area as well. Normally, what we say is the warrants are basically issued till the time we do not issue them a share. That's correct. Because the point is, we are giving them a right that till the time share, we are giving you a right that you can be a shareholder later on. But the point is, it is related to the area of equity itself, but we'll take it in terms of the long term only. Because again, it can be taken to the area of equity shares only. Na? So I will still go with the long term and equity shares. Right? Acha, next question, everyone. A convertible security is what exactly? What would you call a convertible security? A convertible security means a convertible into cash at the holder's discretion, or the bond or preference share convertible at the into an equity share, a bond or preference share that can be converted into an equity share at the choice of the holder, or a security that can be converted into a bond at the choice of the holder. Correct. This is from the book itself, sir. So I'll still go with the book there. Convertible security, everyone. I've covered questions from the IBF book as well. Correct, sir. Okay, everybody going for the point number C. A convertible security means it is basically a form of debt which can be converted into form of equity, and it can also be a preference which can be converted into form of equity. It is not convertible into cash at the holder's discretion. There is call and put options that we can look forward to. A bond and preference share convertible into option and equity share. And then is a bond or preference share that can be converted into equity. Just a moment, please. Okay. Just looking forward towards the audio clarity, everyone. So in this case, the correct answer is the point number C. A bond or a preference share, it is at the choice of the shareholder. That means the bond holder or the shareholder will decide. Was just getting the audio quality checked by the tech team there, everyone. That was the point. It's sorted at the moment. Done? Audible now? Just had a word with the tech team. Since I got replies from you, so I had the tech team on the line so that they can look forward to it. I hope I'm audible now. Okay, so the correct answer is C. It is at the choice of the shareholder. They will decide whether they want to get cash or they want to convert it into equity share. Nobody else can do that for them. Okay? That's the basic rule. Next question. The next question says, which of the following are the two ways to approach asset based valuation methods? What are the two main ways to approach asset based business valuation methods? This is a part of, as such, the module C. Asset valuation is there itself. The question says return on equity. Okay, return on investment concept. Then second point is basically the area of realization concept and cash basis concept, money measurement as well as accrual concept, or going concern and liquidation value. These are the various valuation methods, everyone. Correct answer is B. Okay. B point is realization concept and cash basis. This particular way is there in accounting. In terms of the asset based business valuation model, now there are two ways. One is you consider that the organization is a going concern, then you can record the things at book value, while in terms of liquidation we will record the things at market value. This is the major difference. Okay, so the correct answer would be D, that is going concern as well as the liquidation value. Take everyone? Done? So let's move on towards the next question. It is D, everyone, going concern and liquidation value. Next question, everyone. It says identify the assumptions of the CVP, cost, volume, profit analysis from the statements given below. All the changes in expenses occur during the change in activity level. All units produced are assumed to be sold. The sales price at the fixed cost